Yeah, good evening, everyone.
Good evening.
I hope you're all doing well.
Yes, we are. Yourself?
I'm good too.
It's all good.
All right. So last time we were looking at non-current asset held for sale and discontinued operation. And we have solved questions on single assets. Single assets, when you have an asset that you are no more using it, you want to sell it. How are you going to recognize it? We recognize the asset at the lower of the carrying value or the net realizable value. We solved a question on it the last time. We tried to solve last sittings question, and we will continue today. We will continue today to look at disposable group and also asset head under revaluation model. Before that, let's look at subsequent measurements. If you are carrying the assets, we are saying that the assets should be carried at lower of cost. So if at the date of the classification, the carrying value is 15,000 and the net realizable value is 16,000, we say we should carry the asset at lower of any of the two. So the asset will be carried at 15,000. All right. Assuming the net realizable value was 10,000, the asset will be carried out the 10,000, which is the lower of the two. So what happens after you classify the asset at held for sale and you did a subsequent measurement and you realize that the net realizable value is now 20,000? Is now 20,000. What happened? If we are carrying the asset at 10,000, we are saying that the asset has reduced by 5,000, isn't it? And we are going to have an impairment of 5,000. But if we did a subsequent measurement after classifying the assets, they are now telling us that the net realizable value is now 20,000. It means that the value of the asset has increased from 10,000 to 20,000. So what we do is that we have recognized an impairment loss of 5,000 on the asset. So we now bring the asset to 15,000 by removing the impairment loss that we have already recognized. So the initial recognition is lower of the net realizable value or the carrying amount. But after this, if the asset is subsequently remeasured and there is an increase in the value and you have recognized impairment, use the increase to cancel the previous impairment that you have done on the asset to bring the asset now to what should have been the value if the impairment was not done. That is what we talk about, the subsequent measurement. If the asset is actually sold, you find the amount that you are carrying it and the amount that you sold it. If it is a profit or loss, you recognize it. That is what we talk about, the subsequent measurement. The subsequent measurement, basically, we are talking about the asset held for sale or disposal group is further remeasured before actual disposal, where a further impairment is recognized or gain recognized, but the gain to be recognized must only be to the extent of only previous recognized losses. So if the net realizable value is 17,000 and we are carrying the asset at 15,000, at the further measurements, the asset is now what? 20,000. We can't recognize a gain of 5,000 because we haven't recognized any loss on the asset. So we only recognize the future increase when we have already recognized a loss or an impairment on the asset to cancel the impairment that we have recognized on the asset. So if there's no impairment loss or there's no losses on the asset at the initial measurement, we don't recognize the increase. We just still carry the asset at the value that it should be carried. All right. A gain can be recognized for any subsequent increase in fair value less cost to sell, but not in excess of the cumulative impairment loss that the asset has already been recognized, either when the assets were written down to fair value less cost to sell or previously under IAS 36. So it's just like reversal of impairment. This is like a reversal of impairment. If the classification was not be done, what should have been the value of the asset? We carry that portion, add it to the cost. All right, let's look at the first example. Example 1. Who is reading for us? Kathy, read for us.
Example 1.
Okay.
On 1st January 20X1, AB acquired a building for $200,000 with an expected life of 50 years. On 31st December 20X4, AB puts the building up for immediate sale. Costs to sell the building are estimated at $10,000. Required, outline the accounting treatment of the above if the building had a fair value at 31st December 20X4 of A, $22,000, B, $110,000.
Okay. So we say that whenever you want to classify the asset held for sale, if you say held for sale means that you are no longer using the asset, you want to sell.
You can be reading for us because we need a reader. Oh, hold on.
Okay. So we are saying that when they say held for sale means that we no longer need the asset and we want to sell it. Held for sale means we are only going to recognize cash from the asset through sale, not continual use. All right. So they are saying that they acquired the asset at what? 200,000 on January 2X1. But when are we doing that? When do we decide to sell the asset? When did we decide to sell the assets?
31st December
20X.
Okay, so as at these days, what we have to do, we need to know the net realizable value and then the carrying value, isn't it?
Yes, please.
All right. From the date of purchase to 31 December 2X4, how many years is that?
4 years.
4 years. So if you want to get a carrying value, how do we calculate the carrying value under that?
Would calculate the depreciation up to that time, the accumulated depreciation.
So we have the cost, which is 200,000 minus accumulated depreciation, isn't it? Which
Yes.
will be the 200,000. What is the useful life?
50 years.
50 divided by 50, then times what? All times what?
All times 4.
All times 4. That is the number of years that we have used the assets. So what will be the carrying value?
16,000.
It will be what?
16,000.
Are you sure? 200,000 over 50 is how much?
It will
200,000.
be 4,000.
4,000 times 4 is what?
16,000.
Then we subtract all. Just subtract all before you give me the answer.
It will be 4,000. 4,000. Hey, 200,000. Sorry.
196,000.
196 what? 1,000. So this is our carrying value. This is the carrying value.
186 or 1.
Okay. 196,000. Is it 196 or? Hey.
186.
186. Okay.
No, 186,000.
Okay, 186. So we are saying that if you want to classify the asset, it should be classified as lower of carrying value or its net realizable what? Value. So this is our carrying value. We now come and look for the net realizable value. So the A, what is the fair value of the assets? The A is what?
220,000.
220,000, but we are incurring a cost of what? The cost that we are incurring to sell the asset.
The carrying value will be 184, not 86.
184. Oh. Okay. So our fair value is 220,000, but we are going to incur a cost of 10,000 to sell the asset. So we net the cost against this. So we have the net realizable value to be how much? 210. 210,000. So which of these values that we are going to classify the assets? Which of these values? The assets will be classified at which value?
Lower of the two. So current value.
Which is 184. So the assets will be classified at 184, which is the lower. Let's come to the second part. The second part, what will be our net realizable value?
110.
It will be
110. 110
110 minus what?
minus the 10,000.
Okay.
10,000.
And that will give us how much?
100,000.
Okay. The carrying value will still be the same, isn't it?
Yes.
Okay. So which value are we going to classify this? Which of this?
The 100,000.
At the 100,000.
And what happens to the? We say that the asset has impaired by what? 84,000, because we are carrying the asset at 184. Now they are saying that the value is 100,000. It means that the value has reduced by 84,000, which is the impairment, of the assets. All right. Okay. Let's come to example 2. Like I know, just solve example 2 rather. Okay, example 2.
Line up.
Yeah.
Like notes, I beg you, I have a lot of kids around me. The disturbance will be quite
Is it?
interfering. So if you can have someone to read it.
Yeah, I can have someone to read for you.
I'm babysitting at the same time. I don't want to interfere the class.
Don't worry. Someone will read. I have people here plenty. Auntie Joyce, are you also doing the babysitting?
No, please.
Okay, please read the example 2 for us.
Example 2. Nash purchased a building for its own use on 1st January 2001 for 1 million and attributed it a 50-year useful economic life. Nash uses the revaluation model to account for buildings. On 31st December 2002, this building was revalued to 1.2 million. On 31st December 2003, the building met the criteria to be classified as held for sale. Its fair value was deemed to be 1.1 million, and the cost necessary to sell the building were estimated to be 50,000. Nash does not make a reserve transfer in respect of assets depreciation required. Discuss the accounting treatment of the above.
Okay, so you can see that the person is carrying the asset at what? Revaluation model. All that we know is that the non-current asset held for sale, we do that for only assets that are carried under cost model. But what if the asset is being carried under revaluation model? How do we account for that? Okay, let's say the Nash purchased what? The building at what? January 1, 2x1 for 1 million and attributed it to a 50-year useful economic life. Nash uses the revaluation model to account for building. So when was the revaluation done?
It was 2002, 2 years later.
2 years later. So whenever there's a revaluation, we find whether the asset has increased or the value of the asset has what? Reduced. So 31 December, we need to know the carrying value of the asset. 31 December, we need to know the carrying value of the asset. So the asset was bought at January 1, 2x1. But the revaluation was done at what? That is 1 million.
2002.
So we need to know the carrying value. We need to know the carrying value. Carrying value as at the revaluation date.
Green. Oh. Oh. You know that.
Okay, so we need to know the carrying value as at the day that the revaluation was done. So carrying value at December 31, 2x2, so that we know whether we are making revaluation gain or loss. So what will be the carrying value? The carrying value will be
980,000.
that will be the cost minus the accumulated depreciation, isn't it?
Yes,
So
please.
the cost is 1 million minus what?
20,000.
How would we get a 20,000? It is 1 million over 50 times 2, isn't it?
Yes, please.
Okay, so 1 million over 50.
Oh, it will be 40,000. Understand?
Okay, 1 million over 50 times 2. So if you do it, how much are we getting? Carrying value is equal to what?
960,000.
It is what?
960,000.
960,000.
Yes, please.
It's 1 million.
It will be 960.
Was 0.96. Let's do it in the million. Let's do it in the million. Okay, I'm getting 0.96. Okay. 0.96 million. But if you want to do it in the old currency, I don't have any problem with that. What is the revalued amount now?
1.2.
So revalued amount is 1.2 million. But what should have been the actual value of the asset as at this date?
0.96.
So what is happening? The value has increased, isn't it?
Yes.
So we have a revaluation gain
Revaluation
of
gain.
what? 1.2 minus the carrying amount, which is 0.96. How much is that?
240,000.
240,000. Revaluation gain of
240,000.
0.24 million. All right. So from this date, what will be the value of our assets now? From the beginning of 2S3, January 2S3, what will be the value of our assets?
1.2.
January 2S3. January 1, 2, X3. What will be the value? What will be the new value of the assets?
1.2.
Value of the asset will be the new value, which is 1 point what? 2.
1.2.
What will be the remaining useful life?
It will be 40.
Remaining
46.
useful life will be what? 40 what?
48.
48 years. Okay. So when was the next revaluation done? Okay. On 31 December 2S3, the building met the criteria to be classified as held for sale. Its fair value was deemed to be 1.1 million. So we revalue the asset before we classify it. All those assets that are carried under revaluation model, whenever we are going to classify them as held for sale, you revalue them before you classify them. So we assume that the 1.1 million now is a new value of the asset. So we try to revalue the asset at the end of 2x3. So at the end of 2x3, what will happen? We have used the asset for additional 1 year, isn't it? At the end of 2x3, we have already used the asset for additional 1 year. So the carrying value over there, the carrying value will be equal to 1.2 million minus into brackets 1.2 divided by 48. What are we getting? What will be the carrying amount?
$1.75.
Okay. 1.2 divided by 40, how much are we getting?
0.025.
Okay, minus 1.2. Okay, 1 point, it will be
175.
1.175. This is supposed to be the carrying what? Value. But what is the fair value given to us?
1.1.
Fair value. So the fair value is 1.1. Fair value is 1.1. So what is happening?
Impairment loss.
There will be impairment loss. So 1.1 minus what? 1 minus 1.175. What will be the difference?
0.075.
0.07. So loss of 0.075. This loss will go and you go and subtract the first loss, this loss from the initial gain of 0.24. Okay, so we have revalued the asset, then we now classify it. So what is now the carrying value of the asset? At the date of the classification, the carrying value of the asset is now what? It will be 1.1, which is the new value. Are we okay there? All right. What will now be the net realizable value of the asset at the date of the classification? What will now be the net realizable value of the assets? What will now be the net realizable value of the assets?
1,050,000.
It will be 1.1.
1,050,000.
Okay, how did we get that? 1.1 minus what?
That's the fair value minus 50.
The cost to sell, which is 0.05. Am I correct?
Is it 50 or 0.5?
Okay, 0.05. Am I correct?
Yes.
Is it 0.05? Okay. So what will be the answer?
Yes.
Okay.
1.05.
Okay. So what will be the difference between them? 1.05. So the net realizable value is now 1.05 million. Which one is higher? Which of them is higher? The asset to be classified at the lower, which is 1.05. It means that the asset has further impaired by, let's check this one. So this is now the net realizable value. This is not the net realizable value, and this is the carrying value. But we classify the asset as the lower of any of the two. So you can see that the carrying value is higher than the net realizable value. We can see that the assets are still impaired by what? So there will be a loss of 1.05 minus 1.1. So what is the difference?
$50,000.
That will give us 0.005. What's the total loss of the assets now? What's the total loss on the assets now? What is the total loss on the assets? Total loss will be equal to the 0.05 plus the second one, the first one, which is 0.075. 0.075. So the total loss will be
0.125.
okay 0.1125.
125.
So this will be the total loss. And the initial gain on the asset is what? What was the revaluation gain on the assets? 0.24. So you go and subtract it and see what will be the this one. So you send all these losses to other comprehensive income because the first revaluation gain was sent to other comprehensive income. So the first revaluation is we are going to have a revaluation gain of 0.24 million, which will be sent to other comprehensive income. So the asset will now be carried at 1.2 million, which will have a remaining useful life of 48 years. And after 1 year, the asset was revalued again to 1.1 million. And as at that date, there will be a loss of 0.075. This loss will be subtracted from the initial gain on the assets in the other comprehensive income. And the day that you are reclassifying or you are classifying the asset ahead for sale, there was also additional loss of 0.1. No, it will be 0.05 million. Then you will still go and subtract this from the loss again because the remaining gain over there can take care of this loss. This is how we are going to do this particular one. Let's look at another one. Non-current assets to be abandoned. So if you see non-current asset to be abandoned, we are talking about asset that will be used to the end of their economic life or will be closed rather than sold. So if you say we are not going to, or we are going to abandon the asset, it means that we are going to use it to their useful life, or we are going to close it down rather than selling it. That is the part that they are talking about. All right. So asset that will not be, amount that will not be received through sale, we say we have abandoned that particular asset. We are not going to recover the benefit from selling. We will use it or we close it down rather than selling it. We say we have abandoned that particular asset. Let's look at disposable group. Okay, before we move on, let's come to when there is a change to a plan. When there is a change to a plan. When there is a change to plan. When the standard says that when an asset is being classified for head for sale, the sale should be within 1 year. But sometimes it will happen that the management will not be able to sell the assets after the 1 year. If you're not able to sell the asset after 1 year, the rule is that you should reclassify the assets. The asset should not be held for sale again. But sometimes this particular rule can not hold based on two things. If the delay is caused by an event that is beyond the control of the entity, maybe the government has passed a law that all those who are classified that asset held for sale should hold on. You can't have any control over this. You can't do anything about this. So if the delay is caused by an event or circumstances that is beyond the entity's control, the entity can go ahead and classify the asset as held for sale. If after 1 year they are not able to sell it and management is still committed to the sale, the entity is still committed to the sale, they can still continue to classify the assets. But if these situations are not there, the assets should be reclassified. The assets should be reclassified. If the assets should be reclassified, what we do is that we assume that if the asset was not classified for head for sale, what should have been the carrying value of the assets? Okay. All right. So if after 1 year, the entity was not able to sell the asset, what we do is that we reclassify the asset. How do we do it? We ask ourselves, assuming the classification was not done, what should have been the value of the asset? Then we look at the carrying value of the assets. And at the day that we are reclassifying the asset, what is the recoverable amount of the asset? So we do this to see whether the asset has impaired or not. So if we are reclassifying the asset will be reclassified at the lower of the carrying amount before it was classified or held for sale. Okay. So we ask ourselves, assuming the classification was not down, what should have been the carrying value of the assets? And at the day that we are reclassifying the asset, what is the recoverable amount? Then we classify the assets at the lower of any of the two. We are doing this so that we will not carry the asset more than the value that we should carry it. So we do this to know whether the asset has federally impaired or not. Any adjustment required is recognized in profit or loss as a gain or loss from continual operation. If we talk about discontinued operation, we are talking about, if we talk about discontinued operation is a component of an entity that either has been disposed of, is classified as held for sale. So if we are talking about discontinued operation, is the part of the entity that has been sold off. So if you have a branch in Accra and Kumasi and you have sold off the branch in Kumasi, it means that you have discontinued the operations of the Kumasi brand. That is why we are saying that discontinued operation. If you have so many sections in an organization and you have sold one, it means that you have discontinued the operations of that particular unit. That is a discontinued operation. Or you are classifying it as held for sale. If you are classifying it as held for sale, it means that you are no longer going to carry out activities in that particular division. You have a provision store and you want to sell it. If you want to sell it, it means that you won't go there and be selling things over there again. So we say that you have discontinued the operations of that particular provision store. You have held it for sale or you have sold it. So you can't carry out operations in that provision store again. That is why we are saying that discontinued operation. But what comes under discontinued operation? If you have a major line of business or a geographical area of operations and you want to sell it, like the provision store, that is a discontinued operation, or it's part of a single coordinated plan to dispose of a separate major line or business of geographical area of operations. So if you have a land and you have a store on the land, you want to sell the land, it means that you are selling the land together with the store. So the store, we can say the store is part of what? The land, which is a single coordinated plan to dispose of a major or a separate major line of business. So if you have a land that you want to dispose of the land, it means that you are selling the land together with the store on the land. So we can classify that as also discontinued operation, or a subsidiary acquired exclusively with a view to resell. You acquire a company in Togo. The idea is that you want to sell the company. You acquire them purposely because you want to sell them. You are not going to carry out any other operations over there. You just acquire to sell. So you won't have workers there working. Who are they working for? You want to sell the team. So what are you carrying works over there for? That is the discontinued operation. So they can ask you a question about what qualify an asset to be held or to be classified as discontinued operation. These are some of the things that you are going to write. If it is a subsidiary which is acquired exclusively with a view to resell, or represents a major line of business or geographical area of operations, or is part of a single coordinated plan to dispose of a separate major line of business or geographical area of operations. Okay. Let's look at the presentation of discontinued operations.
Linus.
Yeah.
Please, the question that we just saw, we were told to start the accounting treatment.
Okay.
But we did the calculations. So how do you go about the accounting treatment?
Oh, I've spoken about the accounting treatment. Discuss how the accounting treatment of this one. Since the asset is carried out a revaluation model, it means that at the end of every financial period, the value of the building must be measured to their fair value. That is the first idea about the revaluation reserves or revaluation model. So the first revaluation was done on 31st December 2x2, isn't it? As at this day, we have to know whether we are making a revaluation loss or revaluation gain. Therefore, we have to know the carrying value of the asset as at the day that we are doing the revaluation. So you have to calculate the carrying value, and we have calculated that. we have gotten, how much did we get? Carrying value was, we have gotten 0.96. So the carrying value of the asset was 0.96. We compare with this. So if you compare the difference, you see that the entity is going to recognize a revaluation gain of 0.24. This will be sent to other comprehensive income. Then the following year, you revalue or you find the fair value of the asset as at the date of, or as at the reporting period, which is the 31 December 2x3. So as at this one, they say that the asset made the criteria to be classified at held for sale. Before you reclassify or you classify the asset at held for sale, you first have to measure the asset to its fair value, because the asset is carried under revaluation model. You first have to revalue the asset to its fair value before you classify it. So if you measure it to fair value, you are going to have a revaluation loss of 0.075. Then you now classify the asset at held for sale by comparing the carrying value with the net realizable value. If you do that, you see that the carrying value is still higher than the net realizable value. You still recognize a loss of this. You can't do the explanation without the calculation. So you calculate your figures and use the figures to explain how you are going to account for it.
So the loss will be sent to P&L, right?
So all these gains, all the losses, you'll be saying that they go to statement of profit or loss. The carrying value, this will be the value of the building in the statement of financial position. That is what they are saying. It's not any explanation that they are talking about. How do you account for this? You account for using the figures. Using the figures. As at this day, they should recognize this. They should measure the asset to this. That is all. So they can give you a calculation question and still ask you to explain. They are not saying that you should go and start writing English. No. The explanation can be calculate it and tell us how we are going to report the figures. That is the explanation.
Okay.
All right.
All right. Thank you.
Okay. Okay. So presentation of discontinued operation. On the face of the finance statement of profit or loss and other comprehensive income, a single amount comprising the total of the post-tax profit or loss of discontinued operation and these things. The only thing is the part that you are discontinuing. If you should continue using it, what is the profit or loss that you are going to generate from that portion? So you calculate it and show it on the statement of profit or loss as discontinued operation. So if we should stop operating this particular session, this is the profit or this is the savings that we are going to make, or this is the loss that we are making from discontinuing this particular operation. You show it in the statement of profit or loss. The net gain on the face of statement of, on the financial statement or in the notes, the revenue, expenses, and pre-tax profit or losses of discontinued operation, and this one should be disclosed. So if you are closing that, what is the revenue that you will not be getting from that? What is the savings in tax? What is the expenses that you just disclose all of them? That is what they are saying. Disclosure. There is nothing with the disclosure. Let's look at what we call disposable group. Disposable group. Disposable group. Let's look at what we call disposable group. All right. If we talk about disposable group, it's just like cash generating units, like how we look at it under the impairment loss, cash generating units. So you have a provision store that the table in the provision store cannot generate revenue on its own. The bulb that you have in the provision store cannot generate the revenue on its own. If you decide to sell all the entire provision store, we call that one a disposable group. It means that you are selling a lot of items in a single transaction. If you sell the provision store, it means that you are selling the table, you are selling the bulb, you are selling the container, and you are selling everything in it. So all those assets that will be sold through a single transaction is what we call a disposable group. A disposable group. So a group of assets that will be sold or that will be disposed during a single transaction. That's what we call disposable group. So disposable group is just like a cash generating unit. So after the day that you want to sell the disposable group, what we do is that those assets that are carried under revaluation model, we revalue them before we classify them as held for sale. So we compare the carrying value of the group to the net realizable value. If there's any impairment loss, it will be shared the way we share impairment to what? Cash generating unit. Goodwill, we take it, physically damaged asset will take it, and the rest will be shared among the non-current assets on their values. Let's pick a question on disposable group. Okay, let's look at question. Let's look at question, this one. Question 7. Who is reading for us?
Okay, question 7.
Okay.
Asawasi Limited made a decision to sell a business unit on 15th June 2017, and the criteria to classify the unit as held for sale were met on 1st July 2017. Asawasi Limited's accounting year end is 31st December. At 1st July 2017, the carrying amount of the assets and liabilities of the business unit before any 2017 depreciation or revaluation adjustment was as follows: land and building 120, equipment 50, trade receivables 30, inventory.
When did they want to sell the assets? Made a decision to sell the assets unit on 15 June 2017, and the criteria classified the unit as or held for sale were met on this. As well, counting year end is 31st December at July. And the criteria to classify the assets as held for sale were met on July 2017. Okay. Okay, let's move on. All right.
Additional information 1.
Okay.
The land and buildings are held under the revaluation model of IAS system, property, plant, and equipment, and were last valued on 31st December 2016 to 120 million. Their market valuation on 1st July 2017 was 124 million, and selling costs were estimated at 2.5 million at that date. Residual value was and continues to be expected to be higher than the cost.
Okay. So
The
the assets,
equipment-
they are carried under what? They say the land and building are held under what? Revaluation model.
Revaluation model.
And we are last revalued on what? 31 December to 120.
2016.
Okay, that is 120. Costs were estimated at what? 2.5. The market value on the July 2017 was 124, and selling costs were estimated at 2.5 at that date. The residual value was and continues to be expected to be higher than the what? The cost. Okay, let's move on. Okay.
The equipment is held under the cost model of IS system. The equipment was purchased on 1st July 2015 for 80 million and is being depreciated straight line over 4-year period to a zero residual value. Its sale value at 1st July 2017 was 55 million. Selling costs are insignificant.
Okay. So the equipment was purchased on July 2015 for 80 million. It is depreciated straight line over 4 years to residual value. Its sale value at July 2017 was 55 million. Selling costs are insignificant. Let's move on.
Okay. The trade receivables are recorded at invoice value, reduced by any allowances for credit losses recognized at 31st December 2016. No adjustment to these allowances was necessary at 1st July 2017. The receivables, if factored, will realize approximately 26 million net of transaction costs at 1st July 2017.
Okay.
Should I continue?
Okay, continue.
Okay. The inventories The inventories are mechanized purchase for resale and are held at cost. Their market value at 1st July 2017 was 28 million. Associated selling costs will amount to 1.4 million.
Okay.
It was anticipated at 1st July 2017 that the business unit will be sold for 300 million net of selling costs to
Okay.
a rival company in a single transaction.
Okay.
In respect of Asawasi Limited year ended 31st December 2017, show and briefly explain the amount recognized as non-current asset held for sale under IFRS 5 at 1st July 2017 and the impairment charge, if any, for the business unit.
Okay. All right. So if you are going to dispose a disposable group, the first thing that you have to do is that those assets that are measured under revaluation model, you revalue them before you classify them. You revalue them before you classify them. All right. Let's come to the first footnote. Let's come to the first footnote. The land and building are held under revaluation model of IAS 16, property, plant, and equipment, and we are last revalued on 31 December 2016 to 120 million. So let's go and look at the value of land and building given to us. That was 120 million. So that was from the previous revaluation. Okay. Their market value on July 2017 was what? 124 million, and selling costs were estimated at 2.5 million at that date. Residual value was and continues to be expected to be higher than the what? The cost. You see, when you are selling disposable group, when you are disposing a group, we don't consider individual selling costs for each of the items. We consider the selling cost for the entire group. And this one, this 2.5 over here, we are not selling only the property or only the land and building. We are selling the entire group. So this 2.5 over here is useless. We are not selling the item like one by one. We are selling them as a group. So we consider the selling cost for the entire group. And even if you are revaluing an asset, we don't consider the cost to sell. We just take the fair value. We don't consider cost to sell. It's not net realizable value that we consider. So what you do is that you come and have your land and building. Your land and building. The new value will now be what?
124. Sorry, 120.
No. The old value, that is the old value. We revalue it before we classify. So it will be 120 plus 4, which is now 124. Are we there? The new value is now 124. So we classify the asset to 124 before we remeasure the asset to 124 before we classify it. So the new value will now be 124 million. That is for the building. So what will happen is that we are going to have a revaluation gain of what? 4 million, which will go to other comprehensive income. Let's come to the next footnote. The equipment is held under the cost model of IAS 16. The equipment was purchased on July 2015 for 80 million and is being depreciated straight line over a 4-year period to zero residual value. Its sales value at July 2017 was 55 million. Selling costs are insignificant. We are not selling these assets single-handedly. We are selling them as a group. But what we have to do is that we need to know their carrying value as at this date. If you look at the top there, the question says that liabilities, the carrying amount of the assets at July 2017. At July 2017, the carrying amount of the assets and liabilities of the business unit before any 2017 depreciation, or revaluation adjustment were as follows. So it means that all this value over here, we haven't calculated what 2017 depreciation on them yet. Okay, let's come to this one. Let's come to the second note. When was the asset bought? When was the equipment bought? 2015 for 80 million, isn't it? All right.
Yes.
So 2015 to 2016 is how many years?
1 year.
2016 July to 2017 July is how many years?
2 years.
2 years. So it means that we should have depreciated the asset for 2 years. So depreciation will give us the carrying value will now be the carrying value of the asset as at the date of the classification. Carrying value of the asset as at the date of classification will be the 80 million minus into brackets 80 over 4 times what? 2. Am I correct?
Yes.
What will be the carrying value?
$40.
40 million.
It will be what?
40.
But what is the value there?
40 million.
Okay, that would be the carrying value. But what is the value given to us? What is the value given to us?
50 million.
50 million.
55.
It was 50 to us. No, the carrying value.
50 million.
Okay, 50
It is
million.
50 million, isn't it? All right. It
Yes.
means that we have to further depreciate the asset by what? 10 million.
6 months.
So we charge depreciation of 10 million. 10 million will go to profit or loss as a depreciation. So we now have the equipment, which is the new carrying amount at the date of what? Acquisition. What is the sale value?
55.
So assuming the sale value should be lower than a 50, should be lower than a 40, then we say that the asset has impaired. The asset has impaired, but we are not going to charge the impairment. We just pick the carrying value. So if you know the impairment, then we carry that difference and attach it to the impairment. I will show you what I'm talking about with another example. So this will be 40 million now. Okay. Trade receivables. Trade receivables are recorded at invoice value, reduced by any allowance for credit losses recognized at 31 December 2016. No adjustment to these allowances were necessary at July 2017. The receivables, if factored, will realize approximately 26 million net of transaction costs. Are we factoring something? Are we selling it? Are we selling the receivables? Is the entity saying that they are going to factor the receivables? Do you see any part of the question saying that the entity is willing to factor the receivables?
No, they only said if factored.
Okay, so it means that we are not factoring. The question should give you additional information that, okay, the entity has decided to factor the receivables. So that in that case, we'll be receiving 26 million, but not the 30 million. Okay. So we have receivables. We are not factoring anything. So we still have the 30 million. We are not factoring anything. So we still have the 30 million. All right. The inventories are merchandise purchased for resale and held at cost. The market value at July 2017 was 28 million. Associated with selling costs would amount to 1.4 million. Okay. So what is the current value of the inventory?
28 million.
28 million. Then we subtract 1.4 from it. But what is the actual value of the inventory given to us?
20 million.
It's 20 million. So inventory should be measured as lower of cost or its what?
Net realizable value.
So you can see that the cost is lower. So we still carry the inventory at what?
20 million.
The 20 million. Inventories will still be at 20 million. Okay. Did they say something about payables? No. So that is still the value of the payable. So payables will be, we subtract. We net the liabilities against the asset to know the value of the assets. So this will give us 26. Okay. So this is the All right. What is the current value of the assets? What is the current value of the cash generating units? The disposable good rather. The current value is how much? 188. The current value is 188, isn't it? Is it 188?
Yes, it is.
So what is the net realizable value?
It's 200 million.
200 million. So at what price are we going to classify the assets? Is there going to be any impairments?
No,
And so what value are we going to classify the asset at?
200 million.
No, it's the lower of any of the two.
Oh, okay.
So it will be 188. But if the current value is higher than the net realizable value, then we classify the asset at the net realizable value and write the difference as what? Impairment. So
Okay.
if you are doing disposable group, what you have to do is that all those assets in the group that are measured as revaluation model, measure them back, remeasure them as at the date of the classification, remeasure them to their new fair value before you classify them. Those assets that are classified under cost model, even if there is a real value figure or a new figure to them, no, we don't remeasure it. We just carry the asset under cost less accumulated depreciation. So we classify them as at their carrying value. If you have inventory,
Can
where
you
they are saying that the
begin with?
value has reduced by the inventory, we now classify the inventory as the new value. That is what we do for the disposable group. So if the receivables should have been factored, it means that their carrying value as at that date will be 26 million. Will be 26 million. So the difference will be as a loss. If the inventories, the value, their net realizable value should have been lower than the cost, it means that the inventory will become obsolete. So we now use their net realizable value as the carrying value as at the date of the classification. But if there's nothing like that, we don't do anything. Let me try another question too on this so that the understanding will come better. Which one can we take again? Let me check this. Okay, let's look at question 5. Who is reading for us? Question 5.
Beko Limited acquired all the equity shares in Jamila Limited on 1st January 2018 for a consideration of 1,350 million. The carrying amount and fair value of the identifiable net asset at acquisition were 1,330 million. On 31st December 2020, Beko Limited was in the process of selling its entire shareholding in Jamila Limited, and so it was decided that Jamila Limited should be treated as a disposal group held for sale in accordance with Ifrs 5. Non-current asset held for sale and discontinued operation. At that date, the carrying amount of Jamila Limited net assets before classification as held for sale at 31st December 2020 in the individual statement of financial position are as follows. Property, plant, and equipment, 836 million. Intangible, excluding goodwill, 428. Current asset at recoverable amount, 584. Non-current liability, 322. Current liability, 254. Closing balance, 1272. The group has a policy of revaluing its property, plant, and equipment in accordance with IA system. There have been no revaluation or any other gains or losses included within Jamila Limited. Different components of equity since the date of acquisition, as the carrying amount was deemed to be a close enough approximation to its fair value. However, on 31st December 2020, property with a carrying amount of 330 million was considered to have a fair value of 340 million. No adjustment has yet been made for this fair value. The total fair value less cost to sell off the disposal group at 31st December was estimated to be 1,220 million. There have been no previous impairment to the goodwill of Jamila Limited. Recommend to the directors of Beko Limited how the above transaction should be accounted for in the consolidated financial statement as of 31st December 2020, including financial statement extracts, in accordance with relevant international financial reporting standards.
Okay. That is what they are saying. All right. So let's look at the top. Okay. They say Beko Limited acquired all the equity shares in Jamila Limited on July 2018 for consideration of what? 1,250 million. The carrying amount and fair value of the identifiable net assets at acquisition were what? 1,230 million. So the Beko is paying how much for the asset of the Jamila? How much are they paying for the assets of Jamila? How much are they paying?
1,250.
But what is the actual value of the asset before?
1,230.
So what is happening?
There is
20 more.
There is 20 more. That 20 more, what are they paying for?
Goodwill.
That 20 more is what we call goodwill. Are we there?
Goodwill.
Okay. So we have question 5. They are paying for goodwill. So we have to calculate the goodwill on that date. So the goodwill is equal to the purchase consideration. Goodwill is equal to purchase consideration. Purchase consideration. The amount that you are paying compared to the amount that you should have paid minus the value of the company or asset, value of the company or the assets. Okay. Or net asset. Someone can call it net asset. I don't have any problem with that. Okay. So this will be equal to the 1250 minus 12 what? 30. What will be the goodwill value?
20.
That will give us 20 million. Okay. But come to this place. Beko was in the process of selling its entire shareholding in Jamila, and so it was decided that Jamila should be treated as a disposable group held for sale in accordance with IFRS 5, non-current asset held for sale and discontinued operation at that date. The current amount of Jamila net asset before classification as held for sale was at 31 December 2020 in the individual statement of financial position are as follows. Plants and what? Property, plant, and equipment. 800 days. Intangibles excluding what? Goodwill. The goodwill that they are talking about is what? The one that we have calculated over here. So it's not part of the intangibles there. Since we are putting it, we have to come and add it back. So let's come and see how we are going to the disposable group. What are the values that we are going to attach to them? Disposable group. So the first one is property, plant, and equipment, which is the PPE. Let me just put PPE there. We have meaning. Okay. Come and read the additional information. The group has a policy of revaluing each property, plant, and equipment in accordance with IS. There have no been any revaluation or gain or other losses included in this and this. Okay. However, on 31 December 2020, the property with a carrying value of 330 was considered to have a fair value of what? 340. What is happening? What is happening? It means that the property included in the property, plant, and equipment has increased by 10, isn't it?
Yes.
So we have to, and the date that we are doing the classification was 31 December 2020. So all those assets that are classified as revaluation model, we revalue them to their fair value at the date of classification. So there's a 330 property and plant and equipment has increased by what? 340. It means that property, plant, and equipment figure that we are going to show over here will be the original plus 10. Am I correct?
Okay.
836 plus what? 10, because one has increased by 10. So we add it, then we have 836 plus 10. That will give us 846. What will happen? We are going to recognize a revaluation gain of what? 10 in the other comprehensive what? Income. So the first thing is, first of all, BECO should calculate a goodwill. So we calculated a goodwill already, which they are paying 20 in excess. We calculated that already. And after revaluing their property, they have realized that the property has increased by 10 million. That 10 million will go to other comprehensive income as a revaluation gain. And they have to add it to their carrying value, the 10 as the increase to their carrying value before they classify the property, plant, and equipment. Let's come to the next one. The next one is intangibles. 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 The intangibles, they say is excluding what? Goodwill. So we have 428, but we are getting a goodwill of 20, which is not part of the intangibles, but the goodwill is relating to the subsidiary, which is Jamila. So we have to add it to the intangibles. So we now add the goodwills to now have the total intangibles relating to them. And that will give us 448. Okay. The next one is what? Current assets at their recoverable amounts. So these assets, we are not going to do anything to them. That is their value, 584. We count to non-current liabilities. Non-current liabilities. Non-current liabilities will be the same value, 322 into brackets. Then we count to current liabilities. Current liabilities. There is 2 into brackets, 254 this. So what will be the total value now? What will be the value at the date of classification? It will be all of this. There we go. It will be 1302. 1302. So this is a carrying value. This will be a carrying value. This is the carrying value of the disposable group. But what is the net realizable value?
1,220.
1,200 and what? 20. The net realizable value now is what? Is 1,220. What is happening?
There is an impairment.
So we classify the asset as the lower of any two. So if the carrying amount is higher than this, it means that the asset has impaired. The asset has impaired by how much?
82.
82, isn't it? So the impairment loss of
Yes.
82. So this impairment loss, how are we going to share it? It will be shared like how we do for cash generating units. The first item that will take it will be goodwill. What is the value of the goodwill?
20.
The goodwill will take 20. We'll be left with what? 62. And this 62 will be shared among the other non-current assets. Among the other non-current assets. So the other non-current assets will be property and what? The intangibles, excluding the goodwill, because we have already subtracted the 20 from that one. So we have the share of the impairments. Let me put share of impairment here. Share of impairment loss. goodwill will be the first one to take. If there is no physically damaged asset, goodwill will be the first one to take. Then we come to PPE. Okay. So the PPE value is what? 846, isn't it? Plus the intangibles. Intangibles is 428 because we have impaired the goodwill already. So the goodwill will not be part again. So let's add them and see the total value. It will be 836 plus 428. How much are we getting? So we have 846 divided by the total. The intangibles, which is 428, excluding the goodwill, because we have already impaired the goodwill, plus 846. What is the answer there?
1274.
1274. And this will be the ratio that we are going to share the remaining impairment, which is 62 million. How much are we getting for property, plant, and equipment? How much are we getting for property, plant, and equipment?
$41.17.
Okay.
No.
Yeah.
So in this case, you won't add the current assets, right?
No, the current assets, they are not to be impaired. They say that is their recoverable amount.
Okay.
All right.
Okay. I was
okay.
That is their
Alright.
recoverable amount. So we can't impair them. Are we okay?
Okay.
All right.
All right.
So we only
Okay.
assume that is the
Thank
other
you.
non-current asset that will be impaired.
Linus,
Okay.
before it's the 1274.
Why?
How did you get the 1274?
It is a PP figure
Okay.
because the impairment will be shared, the remaining impairment will be shared among the PP and then the intangibles. So the
Okay.
PP new figure is 846. The intangibles,
Okay.
excluding goodwill, is 428. So you add it. Then you now share the impairment in that ratio. So it will be 846 divided by total times 62. I mean, the goodwill was 20, so the goodwill will take all.
Okay.
All right.
All right. Thank you.
You're welcome. So what will be for the intangibles? What figure is the intangibles taking?
21.
Intangibles will be taking what?
21. I've rounded.
Okay, 21. So you now have your total impairment should be 82. So what will happen? They say you should show extracts. You show other comprehensive income for the gain, which is 10 cedis. You show your statement of profit or loss. You show the impairment, the total impairment, which is 82. So what will happen is that you show statement of financial position, then you show the values after the impairment. So goodwill will no longer be there. Property, plant, and equipment will now be minus 41. Intangibles will now be the 428 minus 21. So you show after the impairment figures. Take the share of the impairment, you subtract it from the original figure. All right.
Okay, Linus, sorry, please, where did you get the 62 million from?
62 million is the impairment. The total impairment is what? 82.
Yes.
Goodwill will take all the 20.
Okay, we have taken the good from
Yes,
it. Okay.
all the 20.
Okay.
Can we move on to reversal when the plan is no longer in existence? What do we do? when the plan is no longer in existence, what do? We reclassify the asset as if the reclassification was not done. So if there was any impairment on the asset, we reverse it. We go and cancel the impairment because we didn't classify the asset at all. So let's look at one question. Then we finish with the non-current asset. So we move on to provisions. All right. Let's look at question 9. Question 9. Okay. Okay. Question
IUPLC.
Question 9.
Okay. IUPLC decided to dispose of one of its major at 31st January 2021. All criteria were met for the plan to be classified as held for sale. On 31st July 2022, that the original sale plan would change, hence it was considered not appropriate to retain the plant as held for sale. Plant is carried under the cost model. Details of the plant are as follows. Cost acquired on 1st August 2019-20. Depreciation straight line to nil, residual value 10%. At 31st January 2022, fair value was 14, cost to sell was 0.4, and then at 31st July 2022, recoverable amount was 15.2. Required, in line with the IFRS 5, my current asset held for sale and discontinued operations, recommend how the above will be accounted for within the financial statement of IU for the year ended 31st July 2022.
Okay. So they say, IU decided to dispose of one of its major production plant, which had become surplus to requirements. At 31, all criteria were met for the plant to be classified held for sale. On 31 July 2017, there was material evidence that the original sale will change, and hence it was considered not appropriate to retain the plant as held for sale. Plant is carried under what? Cost model. Details of the plant are as follows. Cost acquired on August 2017. Depreciation rate straight line to nil is 10%. At 31 January 2017, fair value cost to sell is this. At 31 July 2017, we have recoverable amount to be 15.2. Okay. When was the asset classified as? When are they saying that they are going to classify the asset as held for sale?
31st July 2022.
31st, no. At
held for sale is 31st January
31st January 20 what?
21.
Okay. So what is the reporting period? The reporting period is 31 July 2017, isn't it? All right. Okay. So when was the asset acquired?
1st August 2019.
Okay. So at the day that they are going to do the reclassification, we need to know the current value of the asset as at that date, isn't it?
Okay.
All right. We need to know the current value of the asset as at that date. Okay. Now, these figures given to us should show that at 31 January 20, no, this should be 2021, not because at that date, at the date of classification, we need to compare the current value with the what? The net realizable value. So I'm sure that at 31, this should be at 31, 2021. Let me check the question. Okay. Let's move on. So at 31 December 2021, all criteria were met for the plan to be classified as held for sale. Okay, on 31 July 2017, there was a material evidence that the original plan will change, and hence it was considered not appropriate to retain the plant as held for sale. Plant is carried under cost model. So as at the time that we want to classify the asset held for sale, we need to know the carrying value, isn't it? We need to know the carrying value. So what will be the carrying value as at that date? The asset was bought on.
So please, have you changed the date to 2021?
Is it?
Please, have you changed the date to?
No, the date is still the same. I'll confirm it's still the same. All right.
Okay.
All right.
Okay.
So August 1, 2019 to 31 January 2021. How many months is that? How many years or how many months is that? How many years or months is that?
1.5 years.
Okay. So that would be 1.5 years, isn't it? All right.
Yes.
So at 31 January 2021, what is our carrying value of the assets? What will be our carrying value? Carrying value will be the cost minus the accumulated depreciation, which is 20 million minus into brackets 0.1 times 20 times 1.5. Am I correct? 0.1 times 20 is 1 year. So if you want to get a 1.5 years, you multiply by 1.5. All right. So the carrying value will give us how much? 20 minus what? If we multiply that, what are we getting? (0.1 times 20 times 1.5). What are we getting?
3.
We are getting 3. Okay. 3 million. So what will be our carrying value as at these dates?
17.
17. Okay. 17 million. Okay. But we are not giving what? The net realizable value. So the assumption is that the carrying value is the same as the net realizable value. So we carry the asset at what? The 17 million. We classify the asset as 17 million. 17 million. Okay. We classify the asset as 17 million. Okay. But on July 31, 2022, there was material evidence that the original plan would change, and hence it was considered not appropriate to retain the plants as held for sale. Plant is carried under cost model. But before we come to July 2022, do you have any information that we can subsequently measure the assets? Do you have any information that can help us to subsequently measure the assets? Okay. So we have carrying value to be what? Carrying value to be 17 million. All right. So you can see that at 31 January 2022, we have fair value and we have cost to sell, isn't it? So it means that at 31 January 2022, we can further measure the asset. We can subsequently measure this particular plant. So if you are subsequently measuring the asset, which is a subsequent measurement, subsequent measurement will now be the net realizable value against the carrying value. What will be the net realizable value? It will be the fair value less cost to sell. So fair value less cost to sell is how much? Fair value less cost to sell. Fair value is 14 million minus 0.4. So how much are we getting?
13.6.
13 point what?
6.
6. So if you
Yes.
compare this with the carrying value, we don't depreciate asset held for sale because we are not using it. So the carrying value as at this day will still be 17 million. If there's additional fair value, revalue the assets. If the fair value is lower than the carrying value, it means that there is impairment again. Then you recognize the impairment again. So what will happen? We have a carrying value of 17 million, and we are now having net realizable value of what? 13.6. So we now classify the asset as the lowest, which is the 13.6. It means that we are going to have impairment of what? There will be impairment of 13.6 minus the carrying amount. How much will be the impairment?
3.4.
3.4.
Okay, there will be an impairment of 3.4 million. So the new value of the assets now will be what? The carrying value of the assets now will be. The carrying value of the assets now will be 13.6.
6.6.
But this is exactly 1 year, 1 year after classifying the assets. But they are now saying that on 31 July 2017, there was material evidence that the original sale plan will change, and hence it was considered not appropriate to retain the asset as held for sale. It means that we can no longer classify the asset as held for sale. So what we do is that we now ask ourselves, assuming the asset was not classified as held for sale, what should have been the carrying value as at the day that we are saying that we can no longer classify the asset as held for sale? Assuming assuming the classification was not done, what should have been the value of the assets as at this date? So from 2019 to July 2022, how many years is that? From August, the time that we bought the assets, to the time that we are saying that we are no longer going to classify it as held for sale. How many years is that? How many years is that? July 2019. August 2019 to July 2022. How many years is that?
2 years.
Is how many years?
It's 2 years.
3 years. Okay. Assuming the classification was not done, what should have been the carrying value of the assets? Assuming the classification is not done, what should have been the carrying value? It should have been the original cost minus into brackets 0.1 times 20 times the 3 years, because we use the asset for 3 years. And that will give us how much? That will give us how much? That will give us 20.
16.
Okay. Is it 16?
14.
It's 14.
14.
Okay. So that will give us carrying value of what? Carrying value of what? 14 million. Assuming the classification was not done. So assuming the classification was not done, our value should have been what? 14 what? Million. What is our carrying value now? What is our carrying value now?
13.6.
So what do we do to make it 14 million? Assuming the classification was not done, what are we going to do to make it the 14 million?
We'll add the difference.
The difference is 4, isn't it? But
Yeah.
the day that you are going to classify the asset, you look at the recoverable amount and the carrying value, the original carrying value. The original carrying value should have been 14 million. But what was the recoverable amount given to us?
15.2.
So has the asset impaired? Can we say the asset has impaired?
No.
Can we say the asset has impaired?
No, there is a gain.
No.
No. So since the asset has not impaired, we classify the asset as the lower of any of the two. So we classify the asset as the lower of any of the two. So we still classify the asset as what? The 14 million. But what will happen is that we will add the difference, which is what? 0.4, isn't it? To this. We add a 0.4 to this. The 0.4 to this. That 0.4 will be the one that we send to profit or loss. Because if the asset should be classified, we are going to have a depreciation, but since we classify the asset, we didn't calculate that particular depreciation on it. The depreciation that we should have, after the classification, we didn't charge depreciation for what? 1.5 years, isn't it? The last time that we charged depreciation on the asset was what? 31 January 2021, isn't it? It means that from this time to July, we didn't charge a full year depreciation, a 4.5 year depreciation on the asset. That 4.5 year depreciation should have been 3 million. Should have been 3 million. So since we didn't charge that depreciation, we now assume that the depreciation has been charged to cancel the impairment. So the impairment was 3.4. So assuming we charge the depreciation should have been subtracted from the profits. So since we didn't charge, we assume that the impairment loss, which is 3 million, will cancel that depreciation. Then the remaining, which is a 0.4 on the impairment over here, will be added back to the cost of the new carrying value of the asset, which is the 13.6. And it is a 0.4 that we are going to recognize as a gain. Because assuming we didn't classify the asset, we should have charged a depreciation of 3 million, but we carry impairment of what? 3.4. It means that instead of us charging 3 million, we charge 3.4. So the 3.4 now will be added back to our assets, which is the 13.6 to make it the 14 million. And this 3.4 is the revenue that we are going to send to the statement of profit or loss, not the 3.4. We should have reversed the impairment loss. But included in this impairment loss, we have also not charged depreciation over the period that we classify the asset ahead for sale. So what is the value of that depreciation that we didn't charge? It is 3 million. So that depreciation will not be seen, the 3 million part of the impairment will not be seen as the depreciation that we should charge to statement of profit or loss. So the difference will now be what we are going to use to reverse the impairment, which is the 0.4. It's just like the reversal of impairment loss. This is what they are saying. This is what they are saying. All right. On this note, we are done with we are done with non-current asset held for sale and discontinued operation. Let's move on to provisions. Provisions. Okay. Okay. The provisions that we are going to talk about today is not the normal provision that you have been making for liability. It's not normal provision that you have been making for the normal provision that you have been making for bad debts on debtors. We are talking about provision in respect of an event that you are sure that it is going to happen in the future. Assuming the mining companies, they are going to lease the land from the land commission, and land commission will ask them to bring back the land to their original position or original form. So it means that whatever machines that they have installed on the land, they are going to remove them at the end of the concession period. So what they will do is that, yes, they are going to incur this cost. So how much are we going to spend after the concession period? So we have to start making provision for that particular amount. That is the provision that we are talking about. We're not talking about you saying that, okay, someone bought an item for you. You are not sure that the person is going to pay all the money. So you start making provision for losses. That is not what we are talking about. The provisions that we are talking about over here is a liability that is going to be incurred in the future, but you don't know when you are going to incur it. You are asked to buy equipment for all your workers. You didn't buy, and one of them got injured during the work, the working hours, and he has taken a law or he has taken a legal action against you. With this, you are going to be, or you are likely to pay some damages you'll be paying some amounts for the damages being suffered by your worker at the law courts. So if it is possible, the lawyers are saying that you automatically pay that amount, then you start making provision for the amount that you are going to pay at the time that they say you are going to pay the penalty or the damages to the plaintiff or something. That is what we are talking about. The provisions that we are talking about over here. It's not that you saying that you have sold to someone and that you are not sure that the person is going to pay you or not, and you are going to make provision. That is not what we are talking about here. We are talking about provision that is certain or that is likely to happen. And there's everything telling you that, okay, this is going to happen. So the liability that, the provision that we are talking about over here is a liability. And why should we have the IS 37, which is the provisions, contingent liability, and contingent assets? Why should you have it? You see, if you don't have it, people will just stand up and say, oh, okay, we have the intention to buy equipment in the future. we have the intention to buy the equipment in the future. So let's start making provision for it. Okay, we are sure that we are going to do annual party at the end of the year. Let's start making provision. People will just stand up and be making provisions anyhow and be doing it to reduce their profits and be doing it to reduce their profits. That is why we have the standard to regulate when people should make provision and when people should not make provision. So the provision that we are talking about over here is not provision for bad debts. It's a provision for liability that the entity is likely to incur in the future. Example is you are a driver and the time that you are driving, you knock someone down. You automatically pay for the medical fees of the person. So you can start making provision for the medical fees because there is a condition stating that you are going to incur the medical cost. So you can start making provision for it. Not that you have purchased maybe UCC form and you're saying that they are going to pick you and you start making provision for school fees. What is the assurance that they are going to pick you? What is the proof that they are going to pick you? So the provisions that we are talking about over here, we are talking about you showing something that this is the reason why we are making the provisions. It's not provision for bad debts. It's not provision for any debt or anything. It's not provision for discount. It's a provision for liability that you are going to incur in the future. And before you can make this provision, you have to prove beyond a reasonable doubt that there is a necessary or it is necessary for you to make this provision. And this cause that you are making provision for will be actually be incurred in the future. If at the end of every year, you do send-off party, or at the end of every year, it becomes a norm for the entity that at the end of every year, every employee is going to leave. So the entity can start making provision towards that part of that send-off party because they can prove that per our policy or per our normal patterns, at the end of every year, we normally see an employee leaving the organization. So based on this, we are making provision for this send-off party. There is a proof. But wherever there is no proof, nothing showing that the thing or the cost you are going to incur in the future, don't make provision for it. So what then is provision? Provision is a liability of an uncertain timing or amount. It's something that you know that you are going to incur it, but you don't know when it will happen. When it will happen, just like court case. There's a court case against you and the lawyers are saying that, okay, there's a 80% chance that the company is going to lose the case or is going to, the case is going against you. So it means that at all costs, we are going to pay for the courts, everything that they are going to, the court will deem appropriate, you are going to pay for it. So you can start making provision for that. But when would this amount be paid? You don't know. So that becomes a liability, but you don't know when you are going to pay it. And you don't know the amount that you are going to pay it. So you are not certain about amount. That is the liability that we are talking about. When should we recognize a provision? When should we recognize a provision? The first thing is there should be a present obligation. There should be a present obligation stating that, okay, it is likely that the entity is going to pay this amount or the entity is going to incur this amount. The obligation can be either legal or constructive. If you are talking about legal, we are talking about the law of the country saying that, okay, if you are entity that you operate in this particular industry, you have to make provision for this. Let's look at the mining industries. It is by maybe a law that if you are going to carry out mining activities on the land, at the end of the concession period, bring the land back to its original position. So it means that any asset that you are going to install on the land should be removed. That is why we have the dismantling cost. You are sure that you are going to incur this amount, and it is a present obligation that you are going to remove this. That is the obligation. So you can start making provision for that particular dismantling cost or recycling cost. It is probable that an outflow of resources embodying economic benefit will be required to settle the obligation. Okay, the dismantling cost. Yes, at the end of the concession period, you are going to pay people to dismantle the machine or bring the land back to its original position. So you are going to incur that particular cost, and there's an obligation for you to do that. The obligation can be legal, which is required by law, or it can be constructive. constructive obligation is talking about the policies of the organization. Okay, it is our policy that at the end of every year we do this. So with that, we can prove with the policy. Based on the past patterns of the organization, this has been happening. So therefore, that is why we are making this provision. Those are the things that we are talking about. You should prove why you are making this provision. And you should also prove that you are probably going to pay an amount to settle that particular provision. A reliable estimate can be made of the amount of the obligation. You can tell us that, okay, you are going to pay 10,000 for this. Not that, oh, I don't know how much we are going to pay. Since you don't know how much you are going to pay, don't make any provision because you don't know the amount involved. All right. Let's move on. So the obligation, legal can be contract legislation, constructive can be established pattern of past practice, which is the organization. This is what we have been doing. Or published policy is the policy of the organization to be making provision for these particular items. All right. Let's look at this question. Let's look at the question 1. So anytime that you are going to pick a provision question, ask yourself the question, is there anything telling us to make this provision? Is there anything based on a past experience of the organization? Is there anything to make provision? Is the law saying that they should do this? Those are the things that you see. If there is nothing like that, don't make provision. Don't say that the company should make provision. You can say that there is no present obligation and the amount cannot be measured reliably. So therefore, they should not make any provision. All the 3 criteria must be met. All the 3 criteria must be met. But the major one is the obligation. Let's look at tutorial question 1. An entity has a policy of only carrying out to rectify damage caused to the environment when it is required by local law to do so. For several years, the entity has been operating an oil ring that causes damage in a country that did not have legislation in place requiring any rectification. A new government has now been elected in that country, and at the reporting date has just brought in legislation requiring rectification of environmental damage. The legislation will have respective what effect. Explain whether a provision should be what recognized. Should we recognize a provision? Should a provision be recognized? Should a provision be recognized? Our people, should provision be recognized?
Yes.
Yeah, who is saying yes? Why? Why yes? Why are we saying yes? Forgive.
It's a legal requirement.
Joyce, okay. Why should we make provision? Do you think we should make provision?
Yes, because it's a legal requirement.
It will be
A legal requirement.
okay. It is a though there was no legal requirements. The company has operating and it has been causing damage in the past, but there was no legislation that is saying that they should rectify it. But now a new legislation has been passed, and they are saying that this legislation will have retrospective what effect. It means that if you cause any damage in the past, you are going to rectify it. That is your retrospective. You apply the legislation as if it was there since. That is a retrospective effect. So since the entity has been causing damage, it means that if there should be a case against them for entities that are causing damage, they will be a victim. Therefore, they will pay. So they are already a victim of the damage. They have been causing damage. And if a legislation to be passed right now, they will be held or they will be a victim of legislation. So they are going to pay for any damage that they have caused. But there was no legislation then, so they are not making any provision. But right now there is a new legislation which is presenting an obligation for any entity that is operating in the oil rig industry to make provision for any damage that they are going to cause. And this legislation will have a retrospective effect. It will mean that the legislation was there since you people you are causing the damage. So you make the provision, or you go back and what? Rectify all the damages that you have caused. Therefore, we should make provision, because the legislation is going to have a retrospective effect, assuming that there was an obligation at the day that they are causing the damages. But if this legislation should have a prospective effect, it means that they won't go back and take on those companies that have caused damages in the past. But retrospective effect means that they will go back and take those companies that have caused damages in the past. They are going to face up. So since you have caused the damages in the past, the new legislation is now present an obligation in the past. So you go and rectify all those things for the damages that you have caused. Therefore, we have to what? Recognize a provision. All right. Let's come to example 2, tutorial question 2. You're an accountant working for XZ, a manufacturer that provides warranties to each customer for all sales. And at the terms of the warranty, S undertakes to make good manufacturing defects, that become apparent within 2 years from the date of sale. Based on past experience, it estimates that 8% of goods will be returned for repair within these 2 years.
Sorry.
Okay, a new managing director has recently been appointed and asks you to explain to him why there is an expense in the statement of profit or loss relating to warranty claim that has not yet been received. Prepare a briefing note for the managing director explaining with references to recognition criteria of IS 37 why an expense is required for the potential repairs. So they are saying that a company make goods and they make a provision for 8% of the goods that will be returned for repairs. Okay, if you are going for goods, if you want to know whether you are going to make provision for goods or not, if you are selling 2,000 or 20,000 goods, and they are saying that 2% of these goods will be returned, is the 2% or the 20,000 material? Is it material? Is the 2% on the 20,000 material? What would be the 2% on the 20,000?
400.
400. The 400 is immaterial. It's material.
Yes, it is.
Okay, so when you are taking the estimate on total basis, whether it is 1%, you will still make provision, because if you found 1% on the total, it's going to give you a rich amount. So if you are taking the estimate based on total, you make provision. But if you are taking it on individual basis, so you have sold 100 goods to someone, and you are saying that there are 2% chance that the person will return the goods. Can you make provision for this? There is a 2% chance that the person is going to return the goods. Can you make provision for this 2%? Individual, just 1%. The possibility of the person returning the goods is just 2%. Can you make provision? Can we make provision for the 2% on individual basis?
It's insignificant. It's 2.
It's 2. So there is a 98% assurance that the goods will not be returned. And this 99% is telling you that the goods will not be returned at all. So if you are taking them on individual basis, 5%, and those ones don't make any provision unless they are more than 50. But if you are taking it on total basis, even if it is 0.5%, still make provision. Because you find the 0.5 on the total is going to give you a huge figure. All right. So based on past experience, it's estimated that 8% of the goods will be returned for repair within this years. This one, even there's a past experience. So we can say that there's a constructive obligation based on the past experience, based on the past patterns of the organization. We have been making provision for any or goods that are sold in this manner. So it is part of our experience that the goods, the 8% of the goods will be returned. And even if you take the 8% of the total goods returned, it's material. So since it's material and based on our past experience, people have been returning the goods. Yes, we're supposed to make provision for that because there is a constructive obligation, that is the past experience. And we can also make a reliable estimate that 8% of the goods will be returned. And if they return for repairs, we are going to spend money towards to repair them. So therefore, we should make provision. But if there's no obligation, there's no estimate, and there is no possibility that there will be an outflow of resources, provision should not be made. So whenever you pick a question on provision, look for the criteria, look for the conditions. If the accountant is making provision, why are they making provision? Is there any condition which is necessary for them to make the provision? If yes, is it required by law or is based on the past experience of the organization? It's based on the policy of the organization. These are the things that we see to make provision. Let's look at specific applications of the provision. Future operating losses. Provisions cannot be made for future operation losses as they do not meet the definition of liability. You are going to make a loss. Who are you going to pay to? No. They are expectations rather than an obligation. We are going to make a loss, fine. If we make the loss, are we going to pay or are we going to use money to pay anyone? No. So future operating losses, provisions cannot be made for them. We don't make provision for losses. They are not liabilities. All right. We also have what you call onerous contracts. If you say onerous contracts is a contract where if we terminate it, the benefit that you are going to, or the cost that you are going to incur to terminate it is lower than the cost that you are going to pay to fulfill the contract at the end. So what is happening is that, okay, you have a contract with someone which is 55,000 you are going to pay at the end. But if you should terminate the contract, you pay 45,000. Will you wait and fulfill the contract or you terminate it? You
terminate it.
You terminate it. So if you say onerous contract, is that contract that the cost of avoiding the contract is lower than the cost of avoiding the contract is lower than you fulfilling the contract, or the benefit of fulfilling the contract is lower than it's lower than the cost that you are going to incur to fulfill the contract. So if you see, okay, you are terminating the contract and you are paying 45,000. If you want to continue with the contract, you are paying 55,000. You see that the benefit that you are going to enjoy by terminating the contract is better than you fulfilling the contract. That's what we say onerous contracts. So onerous contract is a contract in which the unavoidable cost of meeting the obligation under the contract exceed the economic benefit expected to be received under it. So this is it. You are going to save 10,000 for not fulfilling the contract. You automatically terminate it. So a provision is required for the least net cost of exiting the contract, which is the lower of the cost of fulfilling the contract, any compensation or penalties payable for failing to fulfill the contract. So if you want to make provision, you make provision for the 45,000 because you are terminating it, so you pay only 45,000. You are terminating it. But if the cost of terminating the contract is 55,000, the cost of terminating the contract is 55,000, and the cost of fulfilling the contract is 45,000. You continue to fulfill the contract and make provision for 45,000. Okay, that is what we call onerous contract. Let's come to future repairs to assets. Some assets need to be repaired or to have parts replaced every few years. For example, an airline may be required by law to overhaul its aircraft every 3 years. Provisions cannot normally be recognized for the cost of future repairs or replacements. Do you know why? Do you know why we cannot make provisions for future repairs? Although the company may say that, okay, it is our policy that at the end of every 2 years, we go and repair the assets. So it's part of our past experience or it's part of our policy. But the standard is still saying that though there's a condition, but don't make provision. The standard is saying that don't make provision because the entity can dispose of the asset and avoid the provision. So you can sell off the asset at any time. So don't make provisions because the asset will not be there. There is nothing telling us that the asset will be there till the repairs, to the time that you are going to do a replacement or anything. You can decide to sell off the asset at any time. So you only pay for the repairs as at when you incur it. This is because there is no current obligation to incur the expense. Even if in the future, the expenditure is required by law, the entity could avoid it by selling the assets. Even if there is a present obligation, the entity can avoid it by selling off the assets. So the provision that we have made become useless. All right. So when you have a future repairs and those things, don't make provision. Even if there is a condition telling you that you have to do it, there is a legal obligation, it's part of the policies of the company to be doing that. They can avoid that by selling off the assets. So therefore, no provision should be made. Example, CEG has 10 years left to run on the lease of a property that it has recently vacated. The present value of the future rentals at the reporting days is 5,000. The cost of terminating the lease early is 55,000. How should the above scenario be accounted for? This is onerous contract, isn't it? So which of these figures are we going to make the provisions for? Are we going for 50,000 or 55,000?
50,000.
We continue with the what? The lease, isn't it? Yes, because the cost of terminating is higher than the cost of fulfilling. So we continue that. Let's come to example. Damboy is a company that owns several shops and which has a year end of 31 December 2x1. One of the shops is loss making. At 31 December, Damboy forecast that this shop will make a loss of 50,000 the year end 31 December 2x4. As at 31 December 2x1, one of the shop's building requires repair. The cost has been reliable estimated at reporting date of 100,000. The repair is made in the following accounting period at a cost of what? 120,000, 12,000. Discuss the accounting treatment of the above in the financial statement of the company for that particular year. The loss, are we going to make provision for the loss?
No.
Yes. No, please.
We don't make provision for loss. But the repairs, are we going to make provision for the repairs before we pay?
No.
No.
We only pay when we incur, isn't it?
Yes, please.
Okay. That is the basic thing that you are talking about. Let's look at what we call restructuring. Restructuring. Sometimes the entity can decide to lay some of the staff off. If you are laying some of your staff off, you are going to pay them. How do they call it? The money that you pay them off something.
Redundancy.
Okay, you pay money for you carrying out that, and that is a necessary cost that you are going to incur, isn't it?
Yeah.
But before you can make provision for that, you have to communicate the plan, the restructuring plan, to the people that are affected. You should have a detailed plan and also communicate your plan to those who are affected. You can also start announcing it or starting to implement it. That is the only thing, because the cost that you are going to incur for terminating your lease, if you have a lease with any company, you are going to pay lease termination cost. That is a necessary cost that you are going to pay. So you have to make provision for it. But you can only make provision when you announce the restructuring plan, when you have communicated to those who are affected. So if you are paying the redundancy fee to your employees, it's a fee that you are going to pay if you start implementing it, so that you can make provision for it. You are going to incur it. But you can only make provision for this cost when you have a detailed plan or you have a formal plan for how the restructuring will be done. And you have also communicated your decisions to the people who are affected. A restructuring is a program plan and controlled by management that materially changes the scope of business undertaken or the manner in which the business is conducted. A provision can only be made if the entity has a detailed formal plan and has raise a valid expectation in those affected that it will carry out the restructuring by starting to implement it or announcing it. Provision can then only be made for costs that are necessarily entailed by the restructuring. You are doing restructuring and you are transferring some of the employees to your next branch. Can you make provision for the cost that you are going to incur for transferring them? Can you make provision for the cost that you are going to incur for transferring them? Okay, let's move on. Not associated with the ongoing activities of the entity. Costs specifically not allowed include retraining, relocation of existing staff, marketing and investment in new systems. If you are retraining the people, you are retraining them for a different job. That is not relating to the restructuring. The restructuring is a cost that is going to make the people to lose their job. Or it's a cost that is going to make the people to be idle, they'll not be doing anything. But the cost that will still be engaging people it has nothing to do with restructuring. So if you are going to pay redundancy fee, lease terminating costs and those things, you can make provision for them if only you have a detailed formal plan on how you are going to carry out the restructuring. You have announced it or you have communicated to those who are affected by the restructuring. Let's come to example 1. On 14th June, a decision is made by the board of directors of KCM to close down a division and a detailed plan is drawn up. At the year ended, no announcement has been made in respect of the closure and no steps have been taken to implement the decision. The expected cost of closing the division are 75,000. Should a provision be made for the expected cost of closing the division? Should a provision be made?
No.
Why?
No.
Because the
They didn't
affected staff have not
communicate
been informed. No
the
communication.
plan to the affected people.
Okay. Although they have a plan, but they haven't made any announcement. So the people are still working there. And they are not even implementing it. If they should start implementing it, it means that the people are now redundant. They are not doing anything. But if you haven't announced it and you are not start implementing, it means that the division is still ongoing. People are still operating there. Operations are still going on there. So you can't make provision because the division is still in what? In section. You can only make provision when you have closed down the division and you are carrying out your restructuring plan. Although they have a plan, but there's still activity going on at that particular division. So we can't make provision for that. Let's come to the question 4 first. The board of CLH agreed to close down 2 of its divisions, A and B, and its board meeting on 18 November 2x3. Detailed plans has been formalized for each division's closure, and these were approved by the board at this meeting. The current status of each of the closure is as follows. Okay. Letters have been sent to customers warning them to seek an alternative source of supply. And a redundancy program was announced to all staff working in the division on December 1. The expected cost of closure was 2.5 million, and it includes 450,000 for redeploying staff to other divisions. Division B. The directors want to deal with the closure one at a time. Therefore, no announcement have yet been made about the closure of Division B. The directors are keen to minimize the effects that the closure will have on staff working in other divisions, and have therefore decided to keep this closure quiet for a moment. The expected cost of closure are 1.5 million. All staff are likely to be made redundant, and therefore no redeployment costs are included in this estimate. You have been asked to prepare a memo. You have been asked to prepare a memo for the board of directors, briefly explain the appropriate accounting treatment of the above decisions in the financial statement of CLH for the year ended 31 December 2x4. Which of these divisions that we should make provision for?
A.
A. Why should we make provision?
Division A.
And how much will be the provision?
2.5 minus 450,000.
Okay, that would be the provision amount, because the cost over
Yeah.
the redeploying cost. This staff will still be working. Since they are still working, we are not going to pay any amount for them. So we take that out. But you can see that they have carried out, or they have given warnings to customers that this division is going to be closed. So they should look for alternative source of supply. And they have also announced the redundancy program for all the staff working there. It means that they are going to be redundant, or they are going to close down that division. Therefore, they can make provision for it because they have a formal plan. They have made announcements that they are going to start implementing, and the people are aware. But let's count to division B. They have the plan all right, but they haven't made any announcements. The people are still working there. It means that that particular division is still in what? Section. Since it's still in section, we can't make provision for it because people are still working. You can only make provision when the people are going to be redundant as a result of the provision or as a result of the restructuring. If the division is still in session, we don't make provision because we are not doing anything to close down the division any moment soon. So we don't make provision. This is about restructuring. Provision, the only way that you can answer the question is ask yourself the question given to you. Is there any obligation for me to make provision? Can I measure the cost of the provision? Is it probable that I'm going to pay money to settle this provision? But if you have these things, then you can go ahead to make provision. Let's look at provision for dismantling costs. When a facility such as oil mine is authorized by the government, the license normally includes a legal obligation for the entity to decommission the facility at the end of its useful life. IS 37 requires a provision to be recognized for the decommissioning costs. It is as a result of the IS 37. That is why we add dismantling costs to the initial cost of what? Assets. Okay. The decommissioning costs form part of the cost of the asset and therefore capitalize an expense over the life of the asset as part of the depreciation charge. So to record the provision, what we do is that always what happens is that we can't make the estimate of the amount that we are going to spend today. So we only make estimates for the future. So at the end of the 40 years, we are going to spend this. So what should have been the value of that amount today? We normally present value it. So if you present value it, you add a present value to your asset and you credit provision for that particular present value. What we do is that we take the cost of capital of the company and be charging it on the provision to the time that we are going to do it. So we keep on unwinding it, charging the interest on it, applying it as a provision, as a finance cost, adding it to the provision till the time that we have the total amount that we have estimated for. So example one. On January 2021, AGC acquires a mine costing 5 million, and as part of the license granted by the government for operations of the time, it will be required to pay this commissioning cost at the end of the mine's useful life. The present value of the commissioning cost is 1 million, and the discount rate is what? 10%. This one they have given us what? The present value already. So what will be the total cost of the assets? The total cost of the mine will be what? Total cost of the mine will be the purchase price. What's the purchase price of the mine?
5 million.
5 million.
What is the present value of the dismantling cost?
1
1
million.
million.
So we add the dismantling cost to that. And that will give us
6 million.
the total will be 6 million, isn't it?
Yeah.
Then we now depreciate this 6 million over the useful life of the asset. So depreciation will now be is equal to the 6 million over 20. Am I correct?
Yeah.
Okay. So what will be the
300,000.
that will give us how much?
300,000.
0.3.
Okay, that will be 0.3. Am I correct?
Yeah.
Yes.
What will happen is that we now have a provision. The provision we'll be making will be 1 million, which is the present value. But this provision, we will start to unwind it with a discount factor. So we are going to have a finance cost on the provision. The finance cost will be the discount rate times the present value of the provision as at every reporting period. So what is the present value of the provision? It's 1 million. So if you do that, what are we getting? We get 0.1 for the finance cost. Our total provision will be 1.1. So if you come to statement of profit or loss, you have depreciation, statement of profit or loss. You have depreciation of 0.3. Then you bring your finance cost. Finance cost, they are all costs. Then you bring the finance cost of 0.1. The finance cost is charged on the present value at the end of each reporting period. So if you want to know the finance cost for the next year, the amount will be charged on the 1.1, which is a total provision. Let's solve additional question on that to see how we go about the provision. Okay, let's look at the question 8. Or question 11 we do. Okay, let's look at the question 8. Let's look at the question 8. Okay. Who is reading for us? Who is reading for us? Who is reading for us? Auntie, forgive. Can you read for us?
Okay.
Okay.
Question 8, right?
Yeah, question 8.
On 1st January 2020, ABC PLC acquired a new mining lease to extract gold through surface of 360 million in Ahafo districts. One of the terms for the grant that ABC PLC have to the land topography to an environmental when the gold deposit would have been exhausted. The estimated cost of capital applicable is 25. In accordance with IAS, the provision, contingent liability, and assets demonstrates how ABC PLC should account for the above information on the financial statement for the year ended 31st December 2020.
Okay. So what is the cost of the mining license? What is the cost of the license? What is the cost of the license?
360.
360 million.
So the cost of the license is Is 360 million. Okay. But are we going to incur any cost to bring the land to its original state? Are we going to incur any cost to bring the land to its original state?
Yes.
And how much is that?
Yes.
100 million.
100 million.
And when are we going to incur this cost?
After 3 years.
After the change has exhausted 3 years.
And they haven't given you the date over here. So what should I, assuming you want to do the dismantling today, what should be the cost? So we present value this. The dismantling cost. You present value dismantling cost and add it to the cost of the assets. What you do is that this is a one-time payment that you're going to make in 3 years. So we use a discount factor, which is the 1/1 plus R or exponent n. So the n over here is what? 3 years. And then the R over here is what? 25. We use the cost of capital of the company. So let's do that. 1/1.25 exponent 3. What will be the answer that you are getting?
0.512.
0.512. Then you multiply by the amount. The amount is what? 100 cedis.
100.
Okay. Another way of doing this is you do the 100 cedis over 1.25, then exponent 3. The 1.25 will be exponent 3. You get the same answer. All right. You can also find the discount factor first before you multiply. If you multiply, how much are we getting?
51.2.
51.2. So the total value of the asset will now be, what? This plus
411.
Okay. So what will be our provision at the beginning? What will be our provision at the beginning? Our provision will be equal to the present value. If we should pay today, this is the amount that we pay to the people. So we are making a provision of 51.2. So that is the initial provision as of today. So they are saying that we should account for the assets. We should account for this for the year end, what? 31 December. So for the year end 31 December, 1 year of the license has already what? Elapsed, isn't it? So we now calculate amortization on the license. We amortize the license over what? 3 years. Amortization will be 411.2 divided by 3. We amortize the license over the life of the license. So amortization will give us what? What is the value of amortization? Yeah. How much are we getting?
137.
133. 137.
No, 137.
137.
Okay.
0.06 or
Okay.
0.07.
Okay. This will be million, isn't it? So this is the amortization. This is the amount that we are going to charge as an amortization to profit or loss at the end of every year. But what happened? At the end of the year, our provision has to increase by what? 25%. So we calculate finance cost on the provision. Finance cost is equal to
Minus is 137.07.
okay, 137.07. Okay.
Yeah.
So our provision has to increase by the cost of capital. We use it to multiply the provision. So 0.25 times the provision that we made. The provision was what? 51.2. How much are we getting as the finance cost?
12.8.
4.8.
8.
Okay.
12.
4.84.
12, not 4. No, 12. 12.
It's 12. Okay.
Yes.
Okay.
0.8.
12.8. Okay, 12.
Yes.
All right. So this is a finance cost. This is a finance cost charged to what? Profit or loss. But at the end of the year, our provision is going to increase by the finance cost. So provision will now be equal to the first provision at the beginning plus the finance cost, which is 12.80. What will be the provision that will be shown in the statement of financial position?
$64.
64. Okay. 64 million.
Yes.
So this will be the figure that will be shown in the statement of financial position. But what will be the figure that will be shown in respect of lances in the statement of financial position? Okay, Joyce, okay. We are saying that on 1st January 2020, ABC acquired a mining license to extract gold through surface mining technology at a cost of 360. So the cost of the license itself is 360. One of the terms for the granting of the license is that ABC will have to restore the land topography to an environmental satisfactory condition in 3 years' time when the gold deposit has been exhausted. The estimated cost of this on 31 December 2022 will be 100 Ghana cedis. So they are saying that if you don't bring back the land to its original condition, we are not going to give you the license. So the dismantling cost or the cost of bringing the land to its original position is what we call the dismantling or the recycling cost. You are incurring this cost as a result of the license, but you are going to pay 100 cedis in 3 years' time. In 3 years' time, but you are acquiring the license today. So the present value of the license is 360. If you should restore the land today, what should have been the value? So we present value the amount, the dismantling cost that we are going to pay in 3 years. We present value it. How do we do that? It is the cost, which is 100, divided by 1 point, or divided by 1 plus R. Let me put it like that, 1 plus R, or let me put future value here, is dismantling cost, the amount that you are going to pay in the future, divided by 1 plus R, all of this 1 plus R exponent N. All of this 1 plus R exponent N. That is how we present value it. The future value, which is the FW, is the amount that you are going to pay at the end of the license period, the amount that you are going to incur to bring back the land to its original position. That is the future value. That is the money that you are going to pay in the future. The R over there is the cost of capital for the company, which is 25% over here. The N is the number of years that you are going to pay this amount, or how many years will it take you to bring the land back to its original position, or in how many years' time are you going to do the dismantling? That is the N. You can see that over here, they will do the dismantling in 3 years. So for you to know the present value, it is the 100 divided by 1 plus 0.25 exponent 3. If you do that on your calculator, how much are you getting?
51.2.
51.2. Okay. This 51.2, you are incurring it because of the license. So it's a direct cost to the license. So we add the present value to the license and now have the total value of the license. So the cost of the license will now be the 360 that we paid and the dismantling cost that we are incurring as a result of the license. So we now have 4111.2 as the license. But this 51 that we have over here is the money that we are paying in the future. So we start making provision for it. So the double entry is that debit the asset, credit provision. So the present value will be the provision. Then after 1 year, they are asking us to show how this particular transaction will be accounted for at 31 December 2020. But we bought the license at 1st January 2020. That is the beginning of the year. That is a full year. So we amortize the license cost now over the useful life of the license, which is 3 years. So we have the license cost, which is a 41.1 divided by 3. We are getting amortization of 137 point this one. Then what will happen is that the amount that we are going to pay in the future is 100 is 100 million, but we are making a provision for 51.2. So what we do is that at the end of every year, we find the interest that we are paying on this one, which we call the finance cost. So at the end of every year, you use the cost of capital to find the finance cost, or you increase the provision by the cost of capital. So for you to do that, you find the 0.25 times the provision, which is 51. So if you do that, you are getting 12.82. This is a cost that you are incurring because of you present value in this particular amount. So you go and add it. So at the end of the day, if you go to statement of financial position, you have your amortization amount, statement of profit or loss, you have your amortization amount, you have your finance cost. But if you go to statement of financial position, your license will be shown as the cost minus the amortization. Your provision will be shown as the initial provision plus the finance cost. So we'll be increasing the provision at the end of every year till we get 100 in 3 years' time. That is how we do it. Joyce, are we on the same path now?
Yes, thank you very much.
Let's look at what we call contingent liability and contingent asset. Then we solve additional 2 or 3 questions. Then we say bye-bye to provisions. Okay. If you talk about contingent liability, we are talking about, though it's an obligation, but you can only pay for it based on something that is going to happen in the future. The happening of the event is dependent on a certain event. So if that particular thing doesn't happen, you are not going to incur the cost. An example is the court case. There is a court case against you, and you don't know whether you are going to pay for anything or you are not going to pay for anything. In this case, there is no obligation telling, though there is a court case, but how much are you going to pay? You can either win the court case or you can lose it. So you can't make provision because this is dependent on something, or how your lawyers are going to defend you, or how the lawyers of the plaintiff is going to carry the case. That is the only time that they can win. So for court case and those things, you don't know how much you're going to pay. You don't know whether you're going to lose or anything. So we can't make provision. That is a contingent liability. So what we normally do is that if you don't know whether the thing will happen or not, you can only disclose it in your footnote that, okay, there is currently a court case against the company. The case is currently under discussion, and you don't know how much you are going to pay for it. So that is a contingent liability. It's a liability, although, but the occurrence of it is dependent on a certain condition. But if there is a court case and your lawyers are telling you that there is 80% that the case is going to go against you, or you will not win the case, it means that you have already lost the case, isn't it? So if the lawyer is saying that you are going to lose the case and you're going to pay 80 million, it means that you have already lost the case and you're going to pay the 80 million, so you can make provision. So if you come to contingent liability, we base our provisions on the estimate of the lawyer. We base our provision on the estimate of the lawyer. If the lawyer is saying that there's 80% chance that you are going to win the case, it means that you are not going to pay anything, so you don't make provision. But if the lawyer is saying that, okay, there is 80% chance that the case is going to go against you, it means that you have lost the case and you are not going to get anything. So you are going to pay automatically. You are going to pay. So you have to start making provision for it. So if you come to situation where, or court case, if it's a court case, we normally base the provision criteria on the reliable estimate of the lawyer. But what happens is that if you are going to pay for filing fee, whether you lose or you win the case, for filing fee, you are going to pay. So you make provision for it. Whether the case was successful or unsuccessful, there is some cause that you are automatically going to incur it, like filing fee. You are going to pay for it. You are going to make provision for it. Whether the case will go against you or not, you automatically make provision for it. So if you come to contingent liabilities or assets, we base our conditions for making provision based on the estimate of the lawyer. If it is a contingent liability that you don't know how the case will be, you only make disclosure. But if it is a contingent asset, although someone is going to pay you like insurance claim, you have an insurance policy and you have involved in accidents, that is the proximate cost of the insurance, and they are going to pay you. Even if the insurance company are going to say that they are going to pay you, this one don't make provision for it. If you receive the money, fine. If it's an asset, we don't care about it. We don't really care about it like that. So if the insurance company is saying that we are going to pay you the money, okay, if any issue happen like this, have they been paying the money? Okay, if there is enough evidence to show that, okay, they will automatically pay the money, then you can go ahead and recognize the claim. But if the insurance authority also tell you that, okay, for any amount that you spent on the damages, we are going to refund it to you, or we are going to compensate it to you, you can only make provisions to the extent of the amount that you have spent so far on the damages. So if you have spent 10,000, the provisions that you make in respect of the insurance claim should also be 10,000, because they told you that they will only compensate to the amount that you have spent on the damages. So if you spend 10,000, you make provision for insurance claim, which is a contingent asset, as also 10,000. But if there's nothing like this, just leave it. Don't recognize a contingent asset. That is a provision. So if there's a provision, it is always based on a lawyer's what? Estimate. Let's look at some examples. Okay. Entity A is
hello, Linus.
Yeah.
Please, my network went off. Please, on the Excel sheet.
You said
there
what?
is something there. How to recognize the assets? How to recognize the assets?
The contingent asset. Is it a contingent
No,
asset?
please. The cost of the license. No, please. The cost of the license.
Okay. So the first one, for you to know the cost of the license, you first look at the purchase price. How much did you purchase the license? Then you have a 360. Then how much are you going to spend to bring the land to its original position? That is the dismantling cost. So what we do is that we present value the dismantling cost. How do we do that? We take 1/1 plus R exponent n. The R is the cost of capital of the company. The N is the number of times that, or the years that.
Yes, I understand that one.
Okay. So which
at the final recognition in the financial statement, maybe at the end of the first year.
It will be the cost. It will be the cost minus any depreciation that you charge or impairment.
Oh, okay.
So the license will be 411.2
okay.
minus the amortization. And the provision will be the initial provision plus the finance cost.
107.07.
Yes. So it means that we have amortized, we have used 1 year of it, and that amount that we have used is the 137.07. So we subtract from the initial cost. Are we on the same path now? All right. Let's look at example 1. Entity A is suing entity B in respect of losses sustained from faulty goods supplied by entity B. Entity A's lawyer are unwilling to state the likelihood of the claim being successful. Entity B's lawyers have told entity B to expect to have to pay damages, but are unable at present to provide a reliable estimate of the account payable. How will each entity account for the above scenario? What will entity A be what will be entity A be getting if they are to pay them? They will be getting assets, isn't it? Entity B will be paying. So the entity A will be having something that we call contingent assets. But their lawyers are not sure whether the claim will be successful. So they can't go ahead and do anything because they don't know whether they are going to receive the money or not. So since the lawyers are not being reliable in their estimates, they don't know what will happen. You don't have to recognize any provision. So they will not even give disclosure because it's a contingent asset. But if you come to entity B's one, they are telling entity B that, okay, they should expect to have to pay damages by and unable at present to provide a reliable estimate of the amount payable. Although they are saying that maybe the case can be successful or not. So prepared for anything. But how much should we prepare for? We don't know. So we don't know the amount that we are going to prepare for. So what we are going to do is that the entity B will not do, the entity A will not do anything, though it's an asset, but they should wait until they pay them, then they should recognize it. Entity B, the lawyers are saying that they should prepare to pay but they haven't given them a reliable estimate. So entity B should disclose the contingent what? Liability. Are we okay there? Okay. Let's go to tutorial questions. Okay. Let's go to okay, let's come to question 6. Let's make this one the last question. Question 6, who is reading? Who is reading? Question 6. Who is reading the question 6 for us?
The following activities took place in 3 different companies. A. Otapiapia PLC, a rat trap company based in Nigeria, has just secured exportation of rat killers to South Africa. The advertising slogan of the rat killer is "Kill the Blacks." A South Africa anti-racism movement with representative in Nigeria is claiming 15 million from the company as damages because the advertising slogan allegedly compromises the dignity of Black people. The company's legal representative believe that the success of their claim will depend on the judge who presides over the case. They estimate, however, that there is 70% probability that the claim will be thrown out and a 30% probability that it will succeed. B. Irene Ankari Motors PLC is a Nigerian company that specializes in the manufacture of made in Nigeria cars. During the current financial year, 100 cars have been completed and sold. During the testing of the cars, a defect was found in their steering mechanisms. All the 100 customers that bought the cars informed of the defect repair at no cost. All the customers have indicated that this is the only remedy they require. The estimated cost of the recall is 10.5 million.
Okay.
Please, can you go down a bit?
Okay.
The manufacture of the steering mechanism, a quoted company with sufficient fund has accepted responsibility for the defect and has undertaken to reimburse Irene Ankari Motors PLC all costs that is might incur in this regard. C. Abeokuta Electricity Company Limited sold a number of electricity transformers with a warranty in the year ended 31st December 2015. At the beginning of the year, the provision for warranty stood at 5,625,000. A number of claims have been settled during the period for 3 million. As at the year end, there were unsettled claims for 300 customers. Experience is that 40% of the claims submitted do not fulfill warranty condition and can be defended at no cost. The average cost of settling other claims will be 52,500 each. Required. Explain how the matters in A to C above should be accounted for in the financial statements of the 3 companies using figures to illustrate your points where appropriate.
Okay. Okay. Okay, let's take them one by one. The following activities took place in 3 different companies. Okay. Ota Bipap, a rat trap company based in Nigeria, has just secured exportation of rat killers to South Africa. The advertising slogan of the rat killers is "Kill the Blacks." A South African anti-racist movement with representative in Nigeria is claiming 15 million from the company as damages because the advertising slogan allegedly compromised the dignity of Black people. The company's legal representative believes that the success of the claim would depend on the judge who presides over the case. They estimate, however, that there is a 70% probability that the claim will be thrown out and a 30% probability that it will succeed. What are we going to do? Do you have to make provision for the 15 million?
We disclose in the note.
Do you have to make provision for the 15 million?
Yes.
Why?
I think
No.
supposed to make a
No,
provision.
it's not possible.
Yes, the percentage of
The
the claim not being successful is higher than, yes. Whenever the percentage,
Oh, yeah, sure. Yes, yes.
whenever the percentage of the claim being successful is higher, then we make what? Provisions. It means automatically on average the claim will be successful. But when the percentage of the claim is lower, it means that this thing is a foolish case. Are you okay? Don't go and take 30% of the 15 million. No, it's not estimate that we are making on the number of people. It's just a fixed amount that we are paying. So the 30% is that the case will be what? Successful. 70 means that is more than 50. It means that the case will be what? Will be a foolish case.
Not
so we can just we can just go and make disclosure about this. There's a 70% probability that the claim will be successful. It means that from where you are seeing it means that they are going to pay at all costs. They are going to pay at all costs. So this particular one, we can't make provision. We can't make provision because based on the estimate of the lawyers, there's no obligation to settle the 15 million in the future because the case is bogus. It's foolish case. All right, let's come to B. Let's come to B. Akari Motors Plec is a Nigerian company that specializes in manufacturing of made in Nigerian cars. During the current financial year, 100 cars have been completed and sold. During the testing of the cars, a defect was found in the steering mechanism. All the 100 customers that bought the car were duly informed of the defect and were told to bring the cars back to have the defect repaired at no cost. All the customers have indicated that this is the only remedy they require. The estimated cost of the recall is what? 10.5. The manufacturer of the steering mechanism, a quoted company with a sufficient fund, has accepted responsibility for the defect and has undertaken to reimburse Akari Motors Plec all costs it must incur in this what? regard. Should we make provision for the 100?
No.
Yes.
Should we make provision for the 100?
Yes.
Should we make provision? Why?
Yeah, we should make provisions because
Why
this is a record.
Okay. Okay. The company has admitted that the cars are what? Defective, isn't it?
Yes,
Okay.
Yes.
and they
And the
will pay.
customers are also, and all customers have also confirmed that the cars are what? Defective.
Faulty.
They have problem with the steering mechanism. It can be possible that 100 of the customers will bring their car for what? Repairs, because they'll be having problem with the
Repairs.
steering. And this, since this is no cost, they are saying that there will be no cost for them. They will surely bring it. They will surely bring it. So you make provision because there is an obligation that the people will bring their what? The cars, because they're having problem with the steering mechanism, and you are telling them that they should bring it. They can bring it. So you make the provision for all the 100 cars, all the 100 the customers. But if they say 70% of the customers will not bring it, then you make provision for 30% of the customers, which will be 30 customers. But this one, we are not giving any percentage. So we made a provision for all the customers, assuming that they will come. Those that will bring it, we fix it and we take the provision out. Those that will bring it, we fix it and take the provision out. Joyce.
Yes, but this one, they said the manufacturer of steering mechanism is taking care of the cost. It means that
we come to
the
that.
RE,
They are saying that they are going to reimburse. So you spend before they will give you the money. It's not that they will give you the money, then you fix the car. You spend before what? They will give you the money. So you can only, this one is a contingent, is money that you are receiving, isn't it? This will be a contingent asset. But you can only make provision to the extent of the amount that you are sure that you are going to spend on the repairs. Because they say that any amount that you spend, they will give it to you back. So you spend before they will give you the money back. So if you are sure that you are going to spend you are going to spend 10.5 for all the cars. You are going to spend a 10.5 on all the cars. Then you can make insurance claim, or you can make you can also recognize what? A contingent asset, which is a claim, which is a reimbursement.
Contingent asset.
Yeah, you can also make provision. So if you are sure that you are going to spend all the 10.5 million, since the people are saying that any amount that you spend, so if you are going to spend 10.5 million, you make provision for 10.5 million as a liability, and at the same time make provision for 10.5 million as a receivable, which is a claim that or reimbursement that you are going to receive from the manufacturer. Are you okay? So you make provision and still make.
Thank you.
And still make.
Yes.
And still recognize an asset, because they say that any amount that you are going to spend, they are going to reimburse you. So if you are sure that you are going to spend all the 10.5 million, then you create an asset to match the liability. So 10.5, 10.5. Are we okay? All right. Let's come to the C.
Yes, thank you.
Let's come to the C. Okay. So they are saying at the beginning of the year, the provisions for warranties stood at what? 5,625,000. A number of claims has been settled during the period for 3 million. So what will be our new level of the provision now? At the beginning,
2.625.
okay. At the beginning, provision was what? So the beginning provision
5,625.
5,625,000. But we have settled some. Settle means we have paid. So we have paid 3 million out of the provision. So the settlement will reduce the provision. So what will be our new provision now? We subtract the 3 million from this. So it means that we have paid 3 million out of this provision. Okay. So what will be our new figure? It will be
2625.
26. So this will be the new balance now on the provision what? Accounts. But as the year end, there were unsettled claims for 300 customers. Experience is that 40 of the claims submitted do not fulfill warranty conditions and can be defended at no cost. The average cost of settling other claims will be 52,500. So they are saying that 42 or 40% of the claims will not be successful, meaning that 60% of the claims will be what? Successful, isn't it? So we need to make provision for only 60% of the claims submitted. So what will be that 60%? What will be the number of claims that will be submitted using the 60%? So we have the successful claims.
180.
Is to be 100 and what? 80. 60% on the 300. Multiply by what? The amount per claim, isn't it? So
Yes.
60% multiplied by 300 times the amount that we are spending on each claim. 52,500. So what will be the value?
9,450,000. 9,450,000.
450 what?
Thousand.
Okay. This is now the new provision, isn't it? This is now the new provision. So as at the year end, there were unsettled claims for 300 customers. Experience is that 40% of the claims submitted do not fulfill warranty conditions. But what is the balance that we have? What is the provision balance that we have? What is the provision balance that we have?
625.
Okay. So our new provision now is 9,450,000. But we have a balance in respect of provisions already. So we just look at the difference. This is a provision. So how much has our provision increased by? So what is the increment? Okay. Our increment is now 6,825,000. So this is the figure that we send to profit or loss as provision. And the new 945,000 will be the one that we now send to statement of financial position as the new provision. So if you talk about provision, it's treated as any other provision. We take only the increase. Our new provision now is 945,000, 9,450,000, but we have a provision balance of this. How much should we add to this to get our new provision now, or by how much our provision increased by? That is what we look at. So we take this particular figure to no. Okay, we take the 6,825,000 to statement of profit or loss. That is the increment in the provision. That is the additional expense that we are incurring as a result of the provision. All right.
Silas,
Yeah.
please take the successful claims again for me.
Can I do what?
Can you please take the successful claims again?
The
You
success.
said we take 60%.
Okay. You see, they are saying that 40% of the claims. What claims are they talking about? They're talking about a claim submitted by the 300 what? Customers.
Yes.
So 40% of the 300 claims will not be successful. It means that 60% will be successful. So we make provision for only the 60. How do we get at least 60% on the 300 claims? And each claim will be settled at 52,500. So you look at the number of claims that will be successful, multiply it by the cost of you settling the claims. Are you okay?
Okay.
Are we on the same path now?
Yes, please.
Okay, let me pick another question. Then we try to see how we can go about it. Then that will be the final one. Be trying some of the questions, we'll be trying them. What are we? Let me just pick one of them. Okay, let's take question 9. Let's take the question 9.
Question 9. A company is being sued by a customer in respect of some product supply which the customer claim are faulty. The customer is suing for 220,000 plus damages. Court costs are likely to amount to 40,000. The company lawyer has advised that there is an 80% chance that the case will be lost and that the full amount claimed by the customer will become payable against the company. The company is fully insured and the lawyer has advised that the insurance policy covers the event and should be
Yeah.
utilized.
We will make-
Required.
make a-
Determine
the last question, then me and go there and do 19. Okay, required.
Determine the amount that should be recognized as a provision and charged to P or L and determine the deferment of the insurance claim.
Okay. So how much will be the provision?
Uh, 220 plus 40,000.
Okay, why are you saying that to be 220 plus 40,000?
I think that is the cost of the supply. And the suing cost and the case cost will be the 40,000.
Okay, so what happened is that they say a company is being sued by a customer in respect of some product supply which the customer claims are faulty, isn't it? The customer is suing for 220,000 plus damage. Court costs are likely to amount the court case with the cost of the courts, whether the claim will be successful or not, you cannot dodge it, you cannot avoid it. If the case will be successful or not, you go to the court before they will tell you whether it will be successful. So you are going to pay for the court costs. So whether the case will be successful, the lawyers are saying that it will be successful or not, you can't, it is unavoidable. So you make provision for that. That is the first provision. Okay. The company's lawyer have advised that there is 80% chance that the case will be lost and the full amount claimed by the customer will become payable against the company. So if they are saying it means that automatically we are going to pay the amount, isn't it? Because they are saying that 80% means that the case is already lost. So we are not going to do anything. So at the end of the day, whatever we do at the court, we will still pay the amount. So we have to make provision for the 220 because we are going to pay it. Okay. The company is fully insured and the lawyer.
Francis Nache of his.
Is that?
Francis Nache.
No, we don't apply the percentage on the cost.
Of your video.
The percentage is just telling us
Okay, thank you.
how the case will be. So the percentage is talking about the case, not the 80% of the cost will be settled. No, it's the chance of the case being successful. So the percentage given to us is relating to the case, not the amount that we are going to pay. So since they are saying that 80% that we are going to, the case will not be won or something, it means that we have already lost the case. So we are going to pay the total amount that the customers are suing us for, which is the 220 plus the court case. the court cost, because we go to the court before we do everything. So that cost, we are going to pay it. The company is fully insured, and the lawyer has advised that the insurance policy covers the event and should be utilized. We didn't receive any information from the insurance company that they are going to pay the amount. So we can't recognize a contingent liability, or we can't create a liability in respect of this particular provision. If they give us the money, fine. Because they are not telling us that they are going to pay us, they are going to give us the money for any cost that we have incurred. They are not telling us anything. So we can create an asset, which is insurance claim in respect of this provision. But total provision that we are going to make will be the 40,000, which is the court cost, plus the amount that we are going to pay to the customer, because they are telling us that we are going to lose the case. So we are going to pay the amount to them. So the total provision will be 260,000. And this should be charged as expense in the profit or loss accounts, and should be shown as a long-term liability in the statement of financial position. We can't recognize the insurance claim because it's a contingent It's a contingent asset. And we are not receiving any information from the insurance company that are going to pay us the amounts. So we just be there when they pay us, fine. When they don't pay us, fine. That is all. So if try the questions, if you have any problem.
So can you disclose it?
Yes, sometimes it's not necessary to disclose, since it's an asset. If it happens that we receive it, fine. But it's only liabilities that you have to disclose, because if you are paying it, your shareholders can ask, why are you paying this amount? Why you didn't tell us? But the asset comes, fine, they will be happy. All right. So this is all about the provisions.
Okay,
if you want to make provisions, look at the conditions. Is there any condition telling us whether we should make provision? If yes, then you go ahead. So we do on estimates, we do on obligations. All right. So I will see the CL people again. All right.